This is Larry Williams, and guys and gals, I think it's time to rock and roll in the stock market. Rock and roll to the upside. And no, this isn't the Larry Williams that sang Boney Maroney and all those great songs so many years ago. This is Larry Williams you see on Stock Charts so often, and I'm really glad that they are going to have me back for this presentation. I've got a lot to show you, a lot of education. I think you're going to really enjoy this. So let's get to it. Here are the three reasons that I expect a major rally to take place in the stock market. They're really important, not only that they have happened, but they're going to help you understand how the stock market works, how the game really works, and help you make market calls yourself in the future. First of all, we have seen panic selling. I call that capitulation. When we've seen massive panic selling, people just unloading stocks, that's what creates market bottoms. When's the best time to buy stocks? When they've been weak, when they've been down, not when they've been up. Well, this is an extension of capitulation. I'm going to show you an example of how effective this indicator has been. Let you decide on what you think is going to happen in the future. So there's more than just capitulation, though, because once the market has a real big slam in the market, it may continue going lower. I mean, I don't hold the truth to the markets. Nobody really does. But I have enough data that we can make some pretty good informed decisions. What I like to see, really love to see, after these big sell-offs in the market is big money coming back in, important buying entering the market. Well, it has, and I'm going to show you how you can tell when that has taken place. So that's really important as well. It's not enough just to have a big sell-off. It's got to say, wait, somebody is really powerful is coming back in here, consistently buying stocks. They think the market's turned. They're big enough that if they think it's turned, I'm going to hop aboard with them. And finally, you know, if you're watching me on Stock Charts very long, I think cycles are important, a really critical tool to help us understand the market. And I am going way out on a limb today with a stock market forecast with a lot of length to it, way out on a limb. We'll get to that in a little bit. But right now, let's look at capitulation in the marketplace. I'm going to take you back to 1958. That's what we're looking at right now. This is stocks in 1958. This is my capitulation or panic index indicator. I've been using this indicator for many years. I'm 10, 12 years now, maybe more, almost 20 years now. It gave a buy signal in 1957, right at the market low. As it did in 1962, this is when I first started following the markets. The actual buy came here. The actual low was about 3 weeks later, but pretty good time to be long stocks. The next time was 1966. I remember this week vividly in my mind for a lot of reasons. And again, the panic indicator got to the extreme level that it signifies we're at a significant market bottom. In this case, it was the week of the low. Almost unbelievable, really, but there's more for you to believe. So we come forward now to 1973. It was early at the low. It came in, gave buy signals here. The market went a little lower, but eventually, if you bought stocks here, you were really rewarded with a big up move in the stock market. Coming forward now, we saw the same thing happen in 1981, just before the 1982 low. Markets went back and forth, didn't go any place, and then exploded to the upside. But there was that panic buy signal. About September, or late September, early October 1981, the start of a huge bull market. And we saw that in 1987. That one was the week of the low, by the way. It actually nailed the absolute low of the market in 1987. That's about when I first began using this indicator, incidentally. So you'll see out of performance moving into the future. In 1990, again, it nailed the market the week of the low. I said there's a lot of panic. Investors panicked. They capitulated. Usually we should buy stocks when that happens, and away went the market. Then again, it happened in 1998, right at the market low, and another bull market. In 2001, it gave a buy signal, what I think was the theoretical market low. We had a great rally in the market, but we came back down, and we got two more buy signals. Well, these were wonderful buy signals. This was, you could certainly say early, but it did lead to a substantial rally, a 6-month, half-a-year rally, immediately following that massive amount of capitulation, which shows when people panic, you don't want to. When people panic, you want to buy stocks. As in 2008, again, the panic signal came early. The massive panic was in here. We went lower, but you bought here and held on because you believe in buying panics. incredible rewards for you at any of these signals. Very profitable. Oh, and then we got another panic signal over here in 2011. And again, the market moved to the upside. So that's capitulation. Capitulation is really critical in stocks and commodities. When everybody just throws it up, that's when you want to look to be a buyer, because that's when the best buying opportunities are going to come, when we've seen capitulation in the marketplace. So let's update that. There was a 2010 capitulation signal, 2011. We got, again, investors just capitulated. I'm measuring this by measuring the emotions in the marketplace, by the way. And they're emotionally fraught. They call the Brooks a sell. And the Brooks a sell. I don't know, sell everything. That's capitulation. That's panic. And these panics are really profitable opportunities. So the next panic opportunity, 2018, that's one we looked at. 2020, you saw me call this in StockCharts.com. Again, we got the week of the low in the market, the absolute low in the marketplace. And again, look what happened just a couple of weeks ago, the week of the low, our capitulation signal, the panic sell signal, gave a buy signal. As my readers of my annual forecast know, we sent out a special bulletin. I think you may have also seen that on StockCharts.com or on Jim Cramer's Mad Money. So the point is, we have seen panic selling in the marketplace. We've seen capitulation, but is that enough? It is enough, I think, on its own. After all, you've just seen 64 years of history of this one particular indicator. I'll let you make the decision how bullish, how accurate this indicator is. But I still do like to see more. I like to see confirmation. We can see confirmation in a couple of ways. One is market breadth. I'll explain that shortly. And the rotation. There's been an interesting rotation in the stock market. I'll be talking about that as well. But first of all, let's look at market breadth. What do I mean by that? Market breadth is simply a measure of the number of stocks that are advancing and declining each day. And that's kind of a really critical number. It's called the advanced decline line. This is something I've been working with since 1962, took it way back in time into the early 1900s. It's a great indicator. John Goddess, a friend of mine, used to call this the master indicator, the advanced decline line. Well, here it is in blue. The advanced decline line is blue. Notice that price dipped back to this area. Okay, so price fell back to over here. But the advanced decline line only fell back to over here. It should have fallen to this same price point. It should have fallen way down here. So on the recent decline in stock prices, the advanced decline line held up better than the market itself did. Again, the market declined back to here. The advanced decline line should have declined to that strong same point, and it didn't. So that's interesting. The majority of stocks weren't as weak as some of the averages, point one. Point two, and I'm sorry we didn't do this a few days ago. This is when I first made the PowerPoint presentation for StockCharts.com. I'll update it here in a moment. The advanced decline line in blue broke out of its trend. And notice using these same points on price had not yet broken out. So the advanced decline line is a leading tool. It will lead the way. Oh, just as up here, look at this. Stocks made a new high. The advanced decline line didn't, saying we have very bearish divergence in the marketplace. And that's negative. Obviously, you can see what followed after that. So that's part of market breadth, where I like to just compare the absolute advanced decline line to price itself to see what's been going on. But there's more we can do with it as well. So let's take a further look. Here we are in a real close-up view. Notice when price got weak in here just recently before the blast off, the advanced decline held better. Point two, when stocks started this rally, they didn't rally back to right in this point, but the advanced decline line blue took out that point a long time ago, saying that price should take out this price point. Price didn't rally above here. The advanced decline did rally above there. Since it's a leading indicator, we should break out. Well, you know, this is where we go now. By the way, I'm working with StockCharts.com, so I can do these presentations on a more consistent basis, not just kind of when the notion hits me. And so, whereas this was prepared in advance of the big breakout we just saw, too bad we didn't do this a couple of days ago, we're going to hopefully work out something so you can have more up-to-date information from Larry Williams, if that's what you're looking for, let us know and let StockCharts.com know as well. So as you can see, the advanced decline is clearly broken out. Now, stocks still aren't above this peak, but advanced decline line, it's going to take it out. Taking that out means price will follow this point as well. So again, this is a great leading indicator, and there's more, as a guy on television says, that I'd like to share with you about the advanced decline line, and that is market breadth. This is something my friend Marty Zweig did years ago. What Marty said is that when we have a tremendous amount of buying coming into the market, we have see 90% or more of the stocks advancing for the day, we can have buy signals in the market. Well, this goes way back to 1982, this chart courtesy of Marty's former partner, Ned Davis. Marty passed away recently. And the buy signals are marked with the arrows. And look at that. There's been some really good buy signals. And yeah, that little one right there, we just got buy signal. Now, it can be early, but considering we've had panic selling, as we did in 2002, and then we see substantial buying come in, just as we saw at the 2020 bottom point, I think that's kind of confirms the action to me. Here's what this looks like. I thought you might enjoy the data here. If we look at 10 to 1 updates, when we've had 10 times more stocks up than down, we can go see how powerful that's been. If you look from 1950 to 2003, 2022, you're up 63 days later, you're up 5% of the time. If we look from 1980 to date, we see about the same thing. 63 days later, you're up 5% of the time. 126 days later, you're up almost 10% of the time, just as we saw. So if we look at all days, 6 months later, you're up 4.4% of the time. So these thrust days, these massive amounts of buying coming into the market are like a trigger mechanism. There's so much thrust that attracts more buying, and the markets continue rallying. Now, I don't use these just anytime. They're bullish on their own, but I like to use them like I'm showing here. Confirmation. Oh, we should have bought them. Panic indicator. Oh, good. Buying is coming into the market. We're there. So what does this look like? This is what $36 trillion looks like on June 24th. Look at this. 95% of the stocks in the S&P were up. Only 5% were down. $36 trillion came in. In terms of the number of stocks in the S&P, 483 or 96% were up. That's it. Hello, goodbye, guys. Market strength has come back in. They're buying again, an excessive amount. It's almost a rush to judgment here to buy stocks. This is what a thrust day looks like. You can follow these days yourself, and now you know how you can get confirmation of these market buy points and low points in the marketplace. I thought you would like this chart. I've marked off recent days when we've had 95% days going back to 2009. You can see when those days are. They are rare. And like I said, we just got one. So this indicator, gosh, almost on its own. I like that, right? When I confirm it with the panic indicator, I think that it tells us we have some type of substantial move coming to the upside, if you will, a rock and roll move. Okay, but we had a Fed hike. Well, you know what? Fed hikes, and people talk about them. I don't watch television, but I get stuff on the internet. I see all these people talking about Fed hike, panic, and other. Well, here's the reality of Fed hikes, okay? I'm going to take you back now to 1994. Every red line is when there was a Fed hike. Some were these 0.75%, 0.25%, 0.5%, doesn't matter. Look what happens when Fed hikes. Oh, prices come down. Oh, prices rally. Prices week before the low. I can't make anything out of that. Sometimes they rally, sometimes they decline. So the Fed hikes are not quite as emotional. Here they are in 1996. I went back for you all the way to 1994, by the way, for this study. Here was another Fed hike, price went sideways. Another Fed hike, down a little bit, and then we went up. So the Fed hike history, the reality, is far different than the talking heads. Here was 2001, we had a lot of Fed hikes. And again, what we see, the market kind of oscillated and didn't go anyplace. Went up, went down, then went up. So you don't have to be too worried about Fed hikes. The market may go up and it may go down. Got a coin in your pocket? Flip it. Now, here were the Fed hikes starting in 1995, 2004, 2005. And you can see basically we continued moving higher. All those were Fed hikes. The Fed was really putting the brakes on the economy, but The stock market is not the economy. GDP is not the stock market. You always have to keep those things in mind. So you can see, I don't know, try to come to a conclusion what a Fed hikes mean. And here's a more history of Fed hikes in 2016 to 2018. Again, you see when Fed has hiked, and it looked like pretty bullish here. Here we start to go sideways. I don't know, right at the market low. So the point is, the Fed hikes may not be as significant as one thinks. So I'd like to focus a little bit on inflation. Those who have followed my reports here at StockCharts.com know that I think inflation is about over. And here's a current chart that backs that viewpoint. I think we're at a cyclical high in inflation. And that's critical because if inflation does start to abate here, be very bullish for stock prices. So how can we predict inflation? Well, inflation is the black line, and the orange line is empty monetary supply growth. And it's pushed forward 18 months. So we get a big influx of money supply, it tends to cause inflation. So this line is a projection of how we should inflate. And it's done a pretty good job of showing inflation trends. And look where we are now. We're at a high in inflation, or high in money supply, which would suggest a high in inflation, which is just one more reason I think that we're going to see less inflation here. We're going to see inflation numbers start to go down. And as they start to go down, that's actually bullish for stock prices. That's going to become the news of the day. And that's going to be a really bullish thing for us in the market. And that's encouraging. Okay, guys and gals, hold on to your hat because here it comes. I have two special things. I'm going to talk about gold in a moment as well. I have a special little blurb I wanted to share with you about gold, what I think is going to happen to gold. But first, let's finish off the stock market, okay? And cycles to me say, hold on to your hat. Here are the cycles that hold up the most. There's a lot of short-term cycles. They come in and out of the market. I don't want to focus on those today. You can look at my forecast on StockCharts.com, the last one I did, see how those forecasts turned out pretty good. I want to focus on the longer ones. There's a 4-year or presidential cycle, 8-year, some people call this a 7-year cycle. This is important. Clearly, the 10-year decennial pattern is immensely important in the marketplace. And there's something called the Metonic cycle, the 19-year cycle. I think maybe it's more like a 20-year cycle, but those are all cycles that we need to look at in the market that I think can be very helpful to us. So let's look at them. Here's the 4-year cycle. This is the 4-year cycle pattern of what we would expect. We'd expect a low about here, a rally up to here, a pullback, and then woo, we will go up in October. So the 4-year cycle does a pretty good job of letting us see the short-term swings in the market, when we should start to rally, right when we did, when we should start to decline, when we did. Pretty good idea of the roadmap. It does not tell us how extreme the rally or the declines will be, but it tells us we're in an uptrend now till around the end of August, a pullback, and around the latter part of September, first part of August. 4-year cycle, presidential cycle says, hold on to your hats. The 8-year pattern is one I really like because I found something in this 8-year, not a cycle, but a pattern. Notice this sharp down, sharp up move, and look what happens right at the market low. Sharp down, sharp up move of 2006. Look what happened. Big market up move. So this pattern is something I have found, and going back to the 1860s, it's been very apparent in the Dow Jones Industrial Average. Here, the last time we saw it, 2014, nice place to be a buyer. And look where we are right here, right now. Of course, this is a much longer term cycle. We don't expect to call the absolute low, but suggest, oh, the end of 2022, we're in this type of move that we saw prior. And this is a pretty good cycle to give us a general idea. So this says up into 2023, we can have a pretty good rally, and maybe we'll go flat after that, who knows. But right now, this is a bullish time in the marketplace, as you can see, based on the 8-year cycle. One reason I think we need to start getting pretty bullish on the market. Okay. Is there more? Sure there is. Let's look at our 10-year or decennial pattern. The decennial pattern was first written about by Edgar Lawrence Smith in the 1920s. Warren Buffett said he was one smart man. He also did a lot of fundamental studies on bond relationships to stock prices. And he wrote about the decennial pattern, strong influence in my work. And the pattern is we start a big up move, then we go sideways, have a nice shorter term rally, and then another big bull market to the upside. Notice this was 1994, big run up on the market. We run up, go sideways, run up. We run up, go sideways, we run up. That's the 10-year decennial pattern or cycle pattern, if you will. Where is it now? Well, the last time we saw it was 2012, had the run up, went sideways, and run up again. And this is where we are now. We've eaten up, if you will, the cyclical weakness of the 10-year decennial pattern, and now up move, pull back, and a bigger up move in 2024. That's how stocks have traded on balance from the 1860s forward. So the 4-year pattern is bullish. The 8-year pattern is very bullish in here. And these are long-term moves. These are not just short-term moves. This is a move of about 3-4 years, right? Look at that. That's a long-term move. So I think that's one reason, again, to hold on to your hat. Then we can look at the 20-year pattern as well. That's been pretty demonstrative. Nice market low back here, big run up. Nice market low back here, big run up into 2008. And here we are now. There's the 2022 20-year cyclical low coming right now. So more reasons from a cyclical viewpoint to be bullish on the marketplace. And that's just really interesting to me. We keep seeing all these cycles coming together, which tells me I can walk out on that limb, holding on to my hat, of course, and expecting higher prices. That means that for the next probably year or so, the best strategy will be to buy big dips, sell big rallies, as opposed to sell rallies and to stay short or be bearish. The bias should be to the upside based on the cycles. We expect the bias of the market on the long side, so you want to play as though we continue to be in a bull market. Now, finally, we can look at that decennial pattern. If we average all years ending in 2, I've done that from 1922 forward. So I took 1922, 32, 42, 52, all those years, average them together. And what we got was a forecast of how all those years ending in 2 have traded. And this is the blue line is how they traded. Oh, look where we are right here, right now. Oh, yeah, it's time to rally, and probably strongly. Do me a favor. Look at what prices did in 1922 or 42 or 62 or 72 or 1982 or 2002 or 2012. Here's ending in 2s and very bullish. That's what you're seeing here. Another reason to go out on that into the limb, holding on to your hat. Okay, let's talk about gold now. I'm going to switch. I think I cannot make it any more clear. Larry Williams is bullish. I could be wrong. I mean, I'm not always correct in the marketplace, but what I think is important is having logical information and deciding not because of Joe Biden or the Federal Reserve or a new moon over San Francisco or some little chart formation, but here are real reasons why we should expect this most likely will happen in the future. And then you make your bets and you do money management and some control on that. But as opposed to so many people I see now are very bearish because, oh, it's the end of the world. Well, why is it the end of the world? Well, because too much money supply, too much this, that. It's an emotional decision. You don't want to be emotional with your money in the markets at all. Okay, gold, speaking of gold and emotion, is a very emotional market. The red line that you see is a consumer price index pushed forward a couple of years. So gold, as you can see, is very responsive to the consumer price index. It should have come down. This shocked all the bears, all the people, the gold bugs, because gold crashed this year. Now, how can it crash when the stock market's down? Well, as you know, if you watch my StockCharts.com presentation, gold usually goes down when stocks decline, almost always. And it did again this year. But now we better get ready to be a buyer of gold because the influence of inflation on gold, you can see it's pretty reliable forecast of what should happen. We should start to see a low in the gold market based on inflation. Now, I've blown that chart up for you a little bit so you can see a little closer. This is a weekly chart, by the way. We're getting close to that market low, a rally, a little dip at the end of the year, and move back up again. So you get a pretty good idea here how inflation can help us understand the future direction of the gold market based on fundamentals, not some emotional, not, the Democrats or the liberals are in charge, or money supply or interest rates. But what really drives gold for the most part is inflation, commercial usage, and the emotions of the public. Okay, here's gold seasonal pattern. This is from StockCharts.com. We have our indicators in StockCharts.com, and here you can see the seasonal pattern of gold usually to rally right here, right now. Another reason to look to be long, find a point to get long gold. Also, if we look in StockCharts.com, my professional accumulation index, the professionals just started to buy it. You can see the last time they bought it over here, and back here. All really good times to buy gold. This is the professional Williams Money Flow Index. It measures professional accumulation. It is StockCharts.com. You can use it on gold or any other market you want as well. So you can see clearly we've seen, again, good money coming into this market to be a buyer. We like that a lot. And gold is undervalued. I like to look at a valuation measure. Gold's recently, you see the undervalued measures when it was undervalued, not overbought, oversold, but undervalued. Notice price in a big uptrend here, but it gets undervalued and undervalued over here. So we see the valuation of gold is undervalued, and we see that professionals have started to come into this market. Wow, we got a lot of stuff going for the gold market here, don't we? And we go a little bit further, the commercials, and this is such an important lesson for you. Oh my gosh. The red line is the commercials. This is from the Commitment of Trader report. That's available once a week from the commodity, go to Commodity Futures Trading Commission, COT report. And the red line is just the commercials. These are the producers and users of gold. This is critical. The green line you see is when they are net long. They hardly ever get net long gold, but when they do, Katie, bar the door. Look what happened last time, the time before that. When they get net long, you want to be long gold. Well, they're not net long yet, but they've been doing a lot of buying, and they may be getting net long. So you want to really watch this one carefully. You see the commercial net long, you want to be long the gold market, because we're probably going to have a really good move coming in the marketplace. So it's really a combination of commercials, the users and producers of this market, they're getting net long. Gold's undervalued. We've seen professional accumulation come into the market. We see the seasonal patterns, the upside, and we see an influence based on the CPI index, or really inflation, all telling us to start looking for a buy signal in gold. The only question is, where are you going to get into gold here? And you can use whatever techniques you have to do that. But in any event, I think you get the message. We should start to see gold rally. We should start to see stocks rally. In fact, we should see a lot of rock and roll here. So until the next time, let the good times roll. I think you're going to see some nice up moves in both those markets. I hope you've enjoyed today's presentation. Look forward to working something out where we do a more regular basis on StockCharts.com. So until next time, this is Larry Williams, as always, wishing you good luck and good trading.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.